It's an understatement to say that small business owners, especially new ones, have a lot on their plates. From marketing and team supervision to managing payroll and bookkeeping, there's a lot to take on. However, one of the most important things a small business owner does is to ensure their taxes are paid on time every year. What's important to keep in mind when setting up a new business is whatever entity you form will determine how your business is taxed. Many small businesses opt to form sole proprietorships. A sole proprietorship is someone who owns an unincorporated business by themselves. It's the easiest and most straightforward business structure to form. Sole proprietorship taxation differs from other business entities like C corporations because the business itself is not taxed separately from the business owner. Instead, the owner reports and pays their sole proprietorship taxes as part of their personal tax return. The IRS classifies this type of taxation as pass-through taxation because the tax liability passes through to the owner of the business on their personal tax return. Sole proprietors will complete a separate form on their proprietorship taxes on Schedule C. Schedule C then gets filed with the personal income tax form, Form 1040. Income taxes are not considered a business expense. Some business owners post income tax payments on their profit and loss statement as expenses. However, this is incorrect for sole proprietors. These payments are considered distributions of equity, not expenses. Some sole proprietors opt to form an LLC. However, some LLCs will still file taxes as a sole proprietor. This is because LLC is a legal status granted at the state level but not the federal level. Therefore, single-member LLCs are subject to sole proprietor taxation. LLCs with 2 or more members are classified as partnerships for tax purposes. However, either single or multi-member LLCs can elect to file their taxes as a corporation by completing IRS Form 8832. Entity formation can provide many tax benefits for new business owners, but it can get complicated quickly if you're unfamiliar with the various structures. Consider consulting an entity formation professional who can ensure you get the maximum benefit from your business structure. Sole proprietors do not pay taxes on the full amount of the business's income. Instead, they will only pay sole proprietorship taxes on the profit of the business. This means they'll get taxed on all profits, total income minus expenses, regardless of how much money they withdraw from the business. Therefore, the sole proprietorship's taxable income will be the net income or net profit number at the bottom of the profit and loss statement, but with a few adjustments. Like any business, sole proprietors can deduct business expenses on their return. However, they'll want to ensure that they're managing their bookkeeping correctly to report taxable income and any applicable deductions accurately. A common mistake sole proprietors make, for example, is recording cash activities such as owners' withdrawals, cash deposits from loans or investments, and debt payments as expenses or income on their profit and loss statement when these activities do not impact taxable income. These incorrectly recorded transactions will mess with the total profit calculation and can result in paying either too much or too little on your taxes. Paying too much is obviously a disadvantage because that's money that a new business owner could be using to grow their operations. Paying too little could result in fines from the IRS, definitely not what a small business owner wants. One of the best parts of taxes for small businesses is the ability to itemize deductions and decrease the overall tax bill. Some common tax deductions for sole proprietors include health insurance deductions, business vehicle usage and mileage, self-employment tax, home office deduction, banking and insurance fees, professional development costs, business meals, traditional IRA contributions, phone and internet services, and professional services. Sole proprietors who want to make the most of their deductions would be wise to consult a professional accountant who can ensure that they're maximizing their deductions and taking advantage of everything they're eligible for. When business owners fail to take advantage of qualified deductions, they're leaving money on the table for the IRS. Sole proprietors are responsible for the following taxes: federal income tax, applicable state income tax, self-employment tax, federal and state estimated taxes paid on a quarterly basis, and if applicable, sales tax. For a full breakdown of estimated taxes, check out the guide in the description or click the link right there. If you're worried about meeting the sole proprietorship tax requirements or don't have the bandwidth to do the work of figuring it out, consider getting help from a professional accountant. Working with an accountant will help your sole proprietorship save money and avoid penalties, and it will leave you with more time to focus on the work your business really needs for getting ahead. Get help now by scheduling a free consultation with 1-800-ACCOUNTANT. As always, thanks for watching. If you found this to be educational, informative, helpful, and entertaining, please like and subscribe and look for 1-800-ACCOUNTANT on your social media channels of choice.